to Leah's Adventure or Leah's Lifestyle, depending on if you're here on YouTube with me or right here on Twitch with me. Today we're reading rule number 1, and we were ending last time on page 25, if you're on with Kindle, on page 25%, page 75 of 324, and we had just finished reading the little cap thing, and we are starting with consistency. Alright, let's do it. Consistent numbers are what we are looking for. The kids' lemonade business didn't give us enough numbers to see if it was consistently growing. I suppose we could have gathered all of the numbers, but they haven't been in business for at least 10 years. I like lots of numbers, and I want to see them going up every year. Here's an example of 10 years of the big 5 numbers for Apollo Group. Okay, ROIC says last 10 years, 95 to 204, 32%. Last 5 years, 99 to 204, 30 years, Last year, 2003 to 2004, it's 36%. And then it shows sales, EPS, liquidity, cash from 1995 in every year until 2024. And it shows if they go up or down for each one, for each year. All values except EPS are given in millions of dollars. EPS is in dollars. ROIC is always given as a percentage, while raw values for sales, liquidity, and cash are typically given in millions of dollars. EPS is always given in dollars. We have to take these numbers, however, and create percentages from them that represent growth rates. Only then can we be certain that they meet our 10% per year on average minimum standard. In this example, Apollo ROIC is staying consistent, and sales, gross profit, EPS, liquidity, and cash numbers are all going up almost every year until 2004. It's obvious this business is consistent. Here's what the 4 numbers look like when we put them on a graph. I converted the numbers to per share for comparison. And then it has this little graph where it shows the sales and the EPS and liquidity line and cash and all that together. The 4 growth rates. As I've just mentioned, growth rates are different from the raw numbers. The chart above shows the rates of growth across the numbers: sales, EPS, liquidity, and cash, determined to some degree the size of the moat and the future value of the business, so they are very important. As you can guess, rates are given in percentages, not millions of dollars. In Chapter 6, I'll teach you how to arrive at growth rate percentages in all 4 categories: sales, EPS, liquidity, and cash. But for now, I want you to become familiar with looking at growth rates and being able to use them to decide on future growth rates for businesses. Ultimately, that's what's important about growth rates. They tell us about the future of the business, and that in turn tells us what is worth today. They tell us about the future of the business, and that in turn tells us what it's worth today. A business that can grow its earnings at 15% a year indefinitely has a higher value placed on every dollar of current earnings than a business that's going to grow at only 5% a year. Moreover, a business that can grow its current dollar of earnings at 15% a year probably has a wide moat, which makes the earning more likely than for the business that grows at 5% with no moat. It would be nice to be able to buy the wide moat company that is rapidly growing its earnings for the same price as the no moat company that is dawdling along. But usually nobody is stupid enough to price them the same. That's what makes growth rates so key. What we pay for today is an expected rate of growth. The higher rate is evidence of a moat, and the moat makes the expectation more certain. That will become significant in later chapter. Free websites such as MSN Money calculate some of the growth rates, but not all of them. I'm pretty sure I wrote down we were going to research MSN Money last. But I think I wrote it right. I'm going to write it here. MSN Money. There we go. I just wanted to make sure I wrote that right. Okay, let me start this over. Free websites such as MSN Money calculate some of the growth rates, but not all of them. Other websites do calculate and display all the growth rates for various numbers of years, but they charge to access their services. These subscription-based sites vary in price, too. So it's smart to know what you're getting and how you plan to use the information. While you might one day join such a subscription-based site to retrieve the information, as most professionals do, it's always good to know how to calculate the rates on your own as backup. It's like this. I know how to grow corn in case I need to do it someday, but I'd rather pay someone else to do the growing and just buy my corn down at the store. Remember, we want sales, earnings per share, liquidity, and cash to be growing faster than 10% per year average over the last 10 years. And to make sure that rates of growth are not slowing down, we'll look at the 5-year and 1-year numbers. These are the 4 growth rate numbers for Apollo Group, calculated in 2005 for the previous 10 years. These 5 years, and then the 1 year. And then it says sales, EPS, liquidity, and as they call them. Note, all figures are yearly averaged. Read from left to right. Look at the first 10-year growth rate, then the 5-year, and finally the 1 year, the most recent year. We first want to ensure that all numbers are at least 10%, and then we want to see if they are going up or going down as we go from looking at the 10-year average to last year's growth rate. From these numbers, we can see that while the sales rates of growth is getting higher, the EPS rate of growth dropped, and so did liquidity and cash. If we just look at a chart of the numbers, Apollo looks pretty good, but if we see those numbers calculated to refer to rates of growth, Apollo suddenly appears to have a problem. If you want to buy Apollo, you're going to have to decide whether this problem that slammed the brakes on its growth rate, whatever it is a one-time situation that Apollo is fixing, or the beginning of a permanent mess that you don't want to own. This is where understanding the business is so critical. If you're not sure you understand, then it isn't an industry for you to be investing in, because these numbers could be showing you a moat that has been permanently and terminally breached. Pretty cool. Seeing the difference between the numbers and the growth rate derived from them, calculating growth rates from the numbers is easy, and I'll take you through it in the next chapter. By calculating growth rates of two competing companies, you can really see what's going on and who's got the upper hand, the wider moat in the industry. Here's Apollo's group compared against ITT Educational. Remember, these numbers reflect rates configured during the writing of this book in 2005. So it's been some time. Okay. Look at the percentage in each category of big 5% growth numbers. Both businesses have great ROIC and sale numbers, all above 10%, but whatever hammered Apollo EPS numbers lately had no effect on ITT. Apollo's EPS growth rate in the past year was down 41%, while ITT continued to grow rate at 26%. Same with equity. Apollo's equity number plummeted to 2%, while ITT held at 23%. But ITT's cash growth got hammered, reaching negative 1%. I would need to know what's going on before I'd feel good by either of these right now. Here's Oracle compared with Sybase. I feel like note time, that would be a fun thing to research and figure out. I think, let's add it to my little research bubble that we'll add today. We'll research. Let's find Apollo and ITT's growth rate. And then I'm just gonna say should I just copy? I might just like copy like ITT and then just kind of like write it like this. This looks super sloppy, but this is how it is. 171, 213, 46. It's 10, 5, and 1. And this is ROIC. Okay, and then 10, 5, and 1, and this will be sales. I don't know if I want to write all this down though. Oh, because it's all right here. I'm on 79. I'm just going to mark the page. Yeah. That will help. That will help a lot. Okay. Yeah, I want to look that up. I want to figure out like how, if they're still around and like what the differences are now. Okay. Okay, and then, oh, he does, here's Oracle compared with Sybase. Okay. All figures are yearly average. Oracle and Sybase, two companies that compete in the database market, are both lukewarm, all in big 5 numbers. Look at Sybase. You see the negative numbers? Its growth rates are going in the wrong direction. Not a good sign. Now look at Oracle. EPS growth rates are sliding down from the 26% to the 18 to 16. Cash growth is sliding from 35 to 16 to 11%. Sales and equity slid, then bounced back up. So Oracle is kind of mixed. Not real clear what's going on, is it? Not what we want. We want it obvious. Maybe it's just a business recession. Maybe there's a new technology that's attacking them both. But who knows? You and I don't need to know. We just need to know they've got problems, and we don't want to know companies with problems, and we don't... We just need to know they've got problems, and we don't want to own companies with problems we don't understand. Scratch these two. Here's General Motors compared with Harley Davidson. So this is like, okay, I feel like I'm starting to understand like what he's saying is like when you find a company that you like think you're gonna do, find its competitor, have them compared to each other, go down the line, see if like either one of them look good enough to be able to be a business to look into more. So I think this will probably be something that we'll be doing a lot of. Get ready. Okay. What was I saying? Here's General Motors compared with Harley Davidson. General Motors EPS growth rate is awesome, but the sales growth rate is far below our 10% requirement. And equity growth rate is going the wrong way, even while cash is bouncing up. Mixed signals again. Unclear what's up. Do you know where this firm is going to be in 20 years? Neither do I. Neither do the guys who are running it. Harley has mixed signals too. Notice that their current sales growth is slipping off below our minimum. EPS is slipping too. Watch out. Could it be the boomers are done buying bikes? The next generation doesn't want Dad's Harley. And on a positive note, equity and cash growth rates are rising. Harley is not so obvious either, is it? Here's the Whole Foods compared with Albertsons. Whole Foods sales, EPS, and equity growth rates are stunning. EPS has slowed to the mid-20s, but that's still a great number. Twice our 10% minimum. That's what we like to see. But the cash growth rate is down. We need to understand what's eating up their cash. Albertsons, on the other hand, is getting killed across the board. If businesses were castles, Albertsons would be blown to bits. Every set of numbers except recent sales is headed south, and none is above the minimum. No questions here, which is the better choice. Yeah, so I guess Whole Foods. Here's Dell compared to Gateway. And then it has like a little half note here. It's easy to find out answers to questions about what a corporation has been doing to eat up its free cash. In the example of Whole Foods, I logged on their website and listened to the reply of their quarterly messages. The managers informed investors that they'd allocate a lot of cash to building new stores. So okay, we'll see the benefit of that down the road. I'll go into more detail about how to find answers to questions like these in a later chapter. Yeah, but a little research sounds about right, you know. Dell's sales and equity growth rates are recovering. EPS is continuing to drop. And cash growth. I'm going to start that over. Dell's sales and equity growth rates are recovering. EPS is continuing to drop, and cash growth rates appeared stuck at weak numbers, 6%. Dell has big numbers that seem to say it has a wide moat, even if things have slowed down lately. Looking at Dell and Gateway, it's not hard to see which one is stronger. Is it? Answer, Dell. If you're not sure, start this chapter over again and read more slowly. If you are investigating Dell in the hopes of buying it someday, you'll discover that Dell spent half of its free cash on buying back its stock. $12 billion was paid to investors out of equity and cash to buy them out. That's actually not a bad thing. If I owned Dell and thought the stock price was well below the sticker price or fair value, I'd want to take the excess cash and buy the stock too. Why? Because I'm getting $1 of value for 50 cents, and if other owners are willing to sell out cheap, that's good for me. I will own more of the pie, and I paid half price for it. Good deal. Oracle managers were doing the same thing with almost all of the Oracle free cash flow. Maybe the managers think their stock is a bargain. If it is, the buyback benefits of remaining shareholders big time. The benefits of the remaining shareholders. The buyback. Why does that sound weird? Does that not sound weird? Hold on. Stop. If it is, the buyback benefits the remaining shareholders big time. Okay, there it is. I was like, it's on 2 different pages. Benefits the... Okay. Buffett loves companies that buy their stock back when it's cheap. However, if they buy it back when it's expensive, the maneuver works against the shareholders. Guess we have to know when the stock is cheap and when it's expensive to know if the company is being well managed. Well, get into that in the next chapter. Remember this, when a company buys back its own stock when the stock is cheap, that's a good thing for us as owners. When a company buys back its own stock at a high price, that's not so good. It may be investing in itself, but it's doing so in a spendthrifty way. Where to get the big 5 numbers? Luckily, we don't have to go digging through long-winded and confusing annual reports anymore to get the information we need. That's what I used to do. Free sites like MSN Money and Yahoo Finance do a fair job of getting us numbers from which we can make a few choice calculations. MSN has 10-year numbers for sales, EPS, and book value per share, same thing as equity. But for cash, the site shows only 5 years. It has return on capital, same as ROIC for 5 years. Professional sites do it better, of course, but they charge for organizing the data because it saves time, and time for pros is money. At first, you may want to copy the data from MSN and make a chart like the Apollo one in this chapter, which has all the raw data organized from 1995 to 2004. This allows you to see 4 of the big 5 all in one place, and from there calculate growth rates quickly and easily. Later, when you gain more experience, all you have to do is look at the big 5 and the wonderful business just jumps off the page. Okay, so we need to make an Excel spreadsheet. Open. And I think what I need to do okay, the big 5. Let's quickly. They just said them too. Hold on. Okay, here they are. For sales. What is happening? Okay. Sales. Oh, that'll be easier. Okay. EPS. Book. Value per share. Cash. ROIC. So the book value per share is actually equity. Is fine. Okay. Oh no, I don't like that. it doing that to me? I don't want it to be a date. Why are you doing that? I don't want it to be a date. Okay. Well. It's fine. I got it started. Okay. Okay, we'll start at where I stopped, like a little bit before. This allows you to see 4 of the big 5 all in one place, and from there, calculate growth rates quickly and easily. Later, when you gain more experience, all you have to do is look at the big 5 and the wonderful businesses just jump off the page. A quick word about looking at accounting docs and numbers. No one approaches this task with relish. I certainly don't. So the best course is to focus on the key numbers and leave the rest. You'll find most of the data presented in the same general format, whether you're on MSN Money, Yahoo Finance, or some other place. You'll locate a company's income statement, sometimes called profit and loss, balance sheet, and cash flow. The income statement presents numbers that reflect what a business has made, what it costs the business, and what's left, and thus sales and earnings. The balance sheet presents numbers that reflect what the business owns, what it owes, and what's left for the owners, and thus equity. And the cash flow shows numbers that reflect what cash came in, what cash went out, and what cash is left, and thus free cash flow. So, through these 3 views of businesses, we get to see the big 5 numbers, and thus then to evaluate our potential rule number 1 companies. I think that page 83, that's the best one for anyone who needs to really try to understand what all these words mean that he's talking about. I'm still kind of learning them, but Okay. You may come across sites that use different terms or extra words that confound the process of extracting only what you need. For example, EPS numbers can be seen as diluted normalized EPS or just diluted EPS. But if you follow through the examples I use in the book, learning how to use MSS Money and Yahoo Finance, you'll gain enough experience to pick up on how to navigate most sites and read financial statements. With practice, you'll become a wizard at locating and manipulating the numbers, no matter which site you're using, and no matter what financial language it employs. If you get stumped by a particular site's way of organizing and naming values, email me. The truth is, most professional investors overanalyze. For us, the business will either leap out as a really good deal or it won't. If it doesn't, we pass. If it does, we go on to the next step. Financial statements. Statements on companies are easy to find online. It takes a certain adjustment period to be able to read them and quickly extract the numbers you need while forgetting the rest. But because they all follow the same general format, no matter what site you use, these easy to become familiar with financial statements include the following documents. Balance sheets includes a summary of assets, what the business owns, liability, what the business owes, and net worth, what's left over when you subtract liabilities from assets, also called equity, over a specific period of time. This is where you find equity and debt numbers. Income statement includes a company's revenues, i.e. sales, expenses, and profits. Look here for the sales and EPS numbers. Cash flow statements, changes in cash from operating, investing, and financing activities. Here's where you find free cash and dividends paid. Navigating MSN Money. The first step to take accessing a company's financials is to input its ticker symbol. On MSN Money, the box is marked Symbols at the top of the screen to the right as of this writing. So that 2005, as of 2005. So that's where you'd enter NKE for Nike, for example. If you're working out the symbol, the program should either automatically figure out the correct symbol for you or ask for some information so you can get the right symbol. Once MSN displays the screen, like Nike's data, you'll see a column on the left-hand side, much like a margin, that lists links to information. Under Research, go to Financial Results. That's where you'll find the link to statements. For ROIC, click on Key Ratios. Under Finance Results, then click on Investment Returns. ROIC is listed as returns on capital. For equity numbers, refer to equity expressed as book value per share, which is under Key Ratios and then 10-year summary. For EPS and sales number, go to Financial Results, click on Statement, and then click on the drop-down box to 10-year summary. For cash flow numbers, call up the cash flow statement and refer to the very bottom line, free cash flow. Navigate Yahoo Finance. Yahoo is very useful for industry information but carries only 3 years of financial data, which is not so helpful for our 4Ms to get industry information. Go to yahoo.com. Click on the Finance button at the top left, scroll down, and look at the menu in the left-hand margin. Click on the Industries, and then Industry Center page will appear. For a complete list of industries, click on Complete List of Industries. Either Industries is listed under the Major Sector heading. Click any of these listings to see a summary of that industry. To see all the businesses in that industry, click on Industry Browser. To see the best and worst of the industry, click on the leaders and laggards, and then select whatever criteria you want in the drop-down. Using professional sites. If you use these sites professionally paying for, you can obtain even more sophisticated data. On my site, www.rule1investing.com, you can get links to such sites. Here are some examples. Investor Business Daily, www.investors.com, Zacks, www.zacks.com, Morningstar, www.morningstar.com, Success, www.successinvestortools.com. It's inactive apparently now. General speaking, the fancier and the more information packed the site, the more expensive it is to subscribe. You can do a lot. However, if not 99% of your rule number 1 work for free sites, and once you get comfortable with the evaluations, you'll feel better about paying for higher quality, i.e. better organized data. Okay, real quick, we got 2 things we need to write down to navigate for MSN Money, MSN Money. Okay. I don't feel like I really need to write down all of how to get to everything because it's probably going to look different now. But what I could do I'll say ROIC because it's gonna say equity. What's the other? EPS, cash flow. Okay, and then a couple websites to check out. www.investors.com, www.Zach. See if they're still up. www.Morningstar. That sounds familiar. Morningstar. And then it says successfulinvestors.com, but I'm still going to write it down just to see. Okay. What about debt? I said at the beginning of this chapter that debt is more of an afterthought than one of the big five. When I teach people about these numbers, someone always asks me about debt, wondering why I don't consider it in one of the big five. Here's what I have to say about that. Businesses are just like families. They borrow when they want something now and don't want to wait. Most of us have borrowed to buy a car or a house because if we wait until we can pay cash, we might never reach the point of buying. Similarly, a business like Whole Foods, when it needs to build a new store, might borrow to pay for it. There's no problem with getting a loan. Everybody and every business does it. The problem starts when you borrow so much that your monthly income must stay the same or even grow bigger, or you won't be able to cover your loan payments. In a default situation, you have to sell the house or the car or whatever you borrowed the money for to pay off the loan. Sometimes people borrow a lot, expecting they're going to get a better job. That is, they borrowed based on future income. And then they lose their job and they can't sell the house fast enough, or they resort to credit cards and they have to declare bankruptcy to keep the debt collectors off their back. And just as a family can borrow too much, getting into too much debt, so can a business. When a business borrows more than it can handle with its income, the managers try to get out of the loans just like you do. They try to borrow more money from some other lenders, or they sell assets to try and pay off the loans, or they can sell a piece of the business and use that money to pay off the loans. But just as with you and me, by the time you really need the money, the banks won't lend you any and you can't sell a thing. Businesses can run into this problem too. The managers borrow a bunch of money to build more stores, and then the economy slows down. Customers start to worry about their own money and spend less in the stores, and suddenly the business is in a serious cash crunch and can't make the payments on its loans that month. It can't sell its stores, and because it's in trouble, no one wants to buy a piece of the business. And then they do what we do to keep the loan collectors at bay. They declare bankruptcy. When that happens, a lot of investors get nasty surprised. Rule number 1, investors want investments that are certain to make money. To be certain we're going to make money, we have to have a predictable business. A business or a family that's carrying a lot of debt relative to its income has an unpredictable financial future. If there are any problems with the economy, a business with a lot of loans might be in big trouble. Just a family with a lot of loans might have a big problems if the breadwinner loses his job and the income is cut down severely. We don't like unpredictability, therefore we don't like a lot of debt in a business. The right amount of debt is 0, but as I've said, lots of companies borrow for lots of good reasons. So let's just say that as long as a company can pay off its debt quickly, it's okay. Same with a family. 0 debt is best, but if you know you can pay off your debt out of the money you save in 1 year, then your debt is probably manageable. Let's say the same for a business. If they can pay off their debt in 1 year for free cash flow, then the debt loan is good. We'll set the maximum payoff time at 3 years. After that, we're not interested. There are other ways to develop debt. we can see it is a percentage of the equity, and the liabilities are just as a percentage of the equity. The popular debt slash equity ratio, but businesses can manipulate those ratios for lots of good and bad reasons. It's better to just know how long it would take to pay off debt and keep the number reasonably conservative, and that's what I'm going to show you how to do. As you are about to find out, all you need in terms of numbers is a company's total long-term debt and its current free cash flow. Obviously, those will be given in millions of dollars. If all you find are percentages listed for debt, try another site for financial data and hunt around on its financial statements for the long-term debt and current free cash flow numbers in dollars. Oof. The rule in debt. To determine whether a business's debt is reasonable, find out if it can pay off its debt within 3 years by dividing long-term debt by current free cash flow. Don't worry so much about short-term debt. Long-term debt is what we want to watch out for, and you'll find it in the balance sheet as simply long-term debt. That looks as a company that has some debt and is trying to Let's look at a company that has some debt and try to figure out if it's acceptable debt or just too much. H&R Block has debt. Here are H&R Block's long-term debt and free cash flow for 2005. Let's ask ourselves, given the company's long-term debt and free cash flow, how long would it take to pay off the debt? This is simple math. Divide 923 million by 304 million. 923 divided by 304, and we get 3. H&R Block can pay off its debt within 3 years of free cash flow, barely. Therefore, H&R's debt is okay, barely. While I don't consider debt the sixth number to evaluate, you'll want to consider debt with your reviewing the financial strength of a business. Besides, you'll come across debt numbers when you're looking at the balance sheet and wonder what to do with them. Once you've said yes to the 5 numbers, go ahead and make sure the debt load is reasonable. Simply divide a company's total long-term debt by its current free cash flow. In all the likelihood, if all the big 5 are lined up and looking good, debt is under control. But if you do see a red flag in the debt area, search for a business with better numbers and no bad debt. Okay, that makes sense. So, first, calculate, EPS, what are they? ROIC, equity, EPS, and cash flow. They're all above 10%. Then go in, divide, cash flow by, or take whatever debt is, divide cash flow over it, and as long as you can do that within 3 years, then it's a good business. That sounds really simplistic, but there is a bit of a work in that. We're definitely going to be testing that out today for sure. Okay, let's see. I want to have a good place for us to stop, but I'm feeling like this might be it, because it goes off for a hot minute. I got 10 minutes. Can I read this all in 10 minutes? Shall we give it? I have more than 10 minutes. I take a minute 20. Let's do it. Let's read. There's no reason not to. We'll just read. It's all good. We can read, Leah. Let's read. Read this book. A little bit of water first. And then we'll get into some research. That'll be good. Okay. The rule has applied to a few businesses in 2000. We're almost ready to learn how to find rates of growth across the big 5. Select businesses that appear to be wonderful and move on to calculate their sticker prices. Before getting out the calculators, I want to show you what happens when I apply the rule number 1 strategy to 2000 to the same group of stocks: Harley, GM, Dell, and Apollo. In 2000, the rule determined I could buy Harley-Davidson and Apollo Group, but not GM and Dell. Remember, the decision was made in 2000, not 2005. So even though Apollo and Harley have had some iffy moments in recent years, in 2000 the rule says to buy them. Here's how, as of 2005, the return on investment would have turned out in each case, had I bought and just held the stock for those 5 years. Keep in mind that you'll learn how to arrive at these dollar values in the upcoming chapters. Harley, the rule said buy at 27. The experts thought it would continue to grow really fast and be worth 120 by 2005. In fact, things have not gone as well with Harley as the experts had hoped. Right after the year 2000 began, the United States slumped into a recession. A lot of jobs were lost, and Harley-Davidson earnings didn't grow even close to what the experts thought. In spite of that, by using rule number 5 years, 5 years later, the investment still produced a nice 100% return, even though the stock was selling for half the projected price for the year 2005. Half. We still made good money. General Motors. The rule said not to buy General Motors in spite of the experts' conservative expectation that it would go up 550% in the next 50 years. The problem was that if the experts were right, the price of the stock in 2000 was well above its value for rule number 1 investors. The rule shows us that companies priced well above their value are the first to go down in a market downturn. That was certainly the case with GM. Priced at twice its value, the stock got hammered over those 5 years. Had I invested, instead of making 50%, the return on this investment would have been a loss of about 70%. The stock is now selling for about 1/3 of the price it would have been selling for if the analysts were right. 1/3. One of the reasons the rule number 1 is so important is that it won't leave you in a bad investment. Without the rule, after 5 years of losing money on GM, the investor who's still holding the stock must see it go up 300% just to break even. A stock that goes up 300% over the next 5 years would have an annual return of 25%. The investors holding GM through a 70% loss must be praying that suddenly the company is going to grow magically at a rate that isn't being projected by either the company or the analysts. By sticking with the stock, those investors are living in dreamland. Dreamland is where a lot of immature investors live who don't want to deal with the reality and who don't understand the rule. Rule number 1 investors do not line in dreamland, ever. If a rule number 1 investor were giving GM 5 years ago, I promise you he wouldn't be sitting on it through a 70% loss unless he became catatonic. Rule number 1 investors have the tools and knowledge to see the reality of the business they have money in and understand that there are better businesses out there for them to spend money and time owning. Dell, one of the best businesses in the world if you think you understand the high-tech hardware business. In 2000, the experts thought it would give an investor a 50% return by 2005, but the price of the stock market wanted in 2000 was too high for rule number 1 investors. Investors who paid it lost 20% of their money. Astonishingly, as you'll later see, if you bought the same stock in 2012 instead of 2002, based on experts' projections in 2002, you would have doubled your money in just 3 years. You lose 20% or double your money. Jeez, just 2 years difference. Apollo Group. The business was a solid rule number 1 investment that, based on experts' projections, was expected to make a huge 700% return by 2005. In fact, things worked out far better than expected, and by 2005, the stock had given rule number 1 investors a 900% return. It was an excellent rule number 1 buy in 2000, and even though its EPS and equity growth slowed in the last year, our overall rate of return over those 5 years was stellar. So based on expert analysis, Harley expected 400% and made 100%, while GM expected 50% and made 70%. Dell expected 50% and made 20%, and Apollo Group expected 700% and made 900%. If risk and reward are as related to everyone as everyone thinks, then GM and Dell, with expected 50% rewards, must have been less risky investments than Harley and Apollo Group, which projected 400% and 700% respectively. That didn't turn out to be true at all. It didn't. In fact, at the time, according to the rule, the higher potential return investments in the case were the low-risk investments. Rule number 1, investors know through personal experience that in any stock market they're capable of finding very low-risk business investments that have very high potential rewards. And conversely, all day and every day, the stock market offers up low-reward investments that have a great deal of risk associated with them. Finally, a word about dividends. Oh my gosh, getting into dividends, hey? Let's pause it there. Okay. Thank you so much for joining me today. Don't forget to like, share, subscribe, and comment. Have you done any research on some businesses, and what do those businesses look like? Give us some like little things down below about what you found. Let's chitty chat about it. And until next time, bright and early, shiny tomorrow morning, 8 a.m. Pacific Standard Time. We'll be back to read again. Bye!